Disclaimer.
Right now, as you're watching this video, there are three numbers the banking system desperately doesn't want you to see. $24 billion, 30%, and $8 to $10 per ounce. These three numbers just triggered what I'm calling the silver betrayal, and by the time most investors realize what's happening, it'll be too late. Today, I'm going to show you the data that connects UBS's crisis, China's export lockdown, and the margin call that just broke the silver market. Because what's happening behind closed doors is not just about silver prices, it's about whether the paper market can survive at all. Here's what you need to understand immediately. The price you see on your trading app for silver is increasingly meaningless. According to data from bullion dealers tracking the Shanghai Gold Exchange, physical silver is trading at premiums of $8 to $10 per ounce above the paper price quoted in New York. If COMEX says silver costs $75, Chinese buyers are paying $83 to $85 for actual metal delivered to their vault. This isn't a small arbitrage opportunity. This is the physical market screaming that the paper market is lying about real supply. December 26, 2024 wasn't just another day of market volatility. It was the day multiple pressure points converged simultaneously. While Americans were unwinding from Christmas, the CME group raised margins by approximately 30%, forcing traders to post an extra $7,500 per contract or liquidate immediately. Silver Flash crashed more than $10 in minutes. But here's the critical part. Even as paper prices collapsed, physical premiums in Asia actually increased. Chinese buyers looked at the crash and accelerated their purchases of actual metal, draining Shanghai inventories at a catastrophic 56% rate over just 90 days. Let me connect these dots because this reveals our financial system's biggest vulnerability. UBS operates as one of the largest market makers in the London Bullion Market Association, the organization that sets global silver benchmark prices. Now, Swiss regulators are demanding UBS post an additional $24 billion in capital, according to the bank's June 2025 regulatory filings. Think about what happens when a major bank holding significant short positions in precious metals derivatives suddenly needs to free up $24 billion, while the CME simultaneously makes it exponentially more expensive to hold silver futures. You're witnessing a coordinated squeeze forcing massive covering of short positions right as physical supply vanishes. Pop quiz. When was the last time you heard about silver lease rates? In normal markets, banks charge around 0.3% to borrow silver, basically free money. But according to bullion dealer data from late December, lease rates spiked toward 40%. Banks only pay 40% annual interest to borrow silver if the alternative is catastrophic, like defaulting on delivery obligations. These aren't normal commercial rates. They're distress signals from institutions trapped on the wrong side of a physical shortage. Now watch what happened in China. According to Bloomberg, Chinese silver exports hit a record 660 tons in October 2024, with exporters desperately front-running new restrictions. On January 1, 2026, China implemented a 2-year special licensing system requiring exporters to demonstrate annual production exceeding 80 tons and maintain $30 million credit lines. In practical terms, China just locked down control over 60 to 70% of global tradable silver supply. Meanwhile, Shanghai Futures Exchange warehouse stocks collapsed from over 1,100 tons to approximately 620 tons by early January, a drawdown of 480 tons in under 3 months. Industrial demand doesn't move that fast. What you're seeing is Chinese participants converting paper to physical at panic rates because they don't trust the paper market can deliver. Here's where this hits your wallet directly. According to the Silver Institute, industrial applications account for 60% of silver demand. Solar panels, electronics, electric vehicles, medical equipment. When Chinese restrictions cut 7 to 10% of global supply, American manufacturers compete for shrinking metal. Those higher costs flow straight to consumer prices for solar installations, electronics, and vehicles. The silver shortage isn't trader abstraction. It's an inflation bomb heading for everyday Americans. Think about your retirement account. Most target date funds systematically reduced commodity exposure based on models assuming paper futures accurately reflect physical scarcity. But what if paper and physical markets have diverged so catastrophically that those models are now lethally mispriced? When paper contracts can no longer substitute for actual metal, risk models collapse, potentially exposing millions to losses they didn't know they were taking. According to the Commodity Futures Trading Commission's enforcement records, 8 major banks paid over $1.3 billion in fines for precious metals manipulation between 2008 and 2016. JP Morgan alone settled for $920 million for systematically spoofing silver markets. This isn't conspiracy. These are documented federal settlements establishing criminal manipulation. The question is whether those incentives actually changed or just evolved into forms regulators can't detect. Let me show you what's broken in the physical market. The London Bullion Market Association operates on an unallocated basis. You don't own specific bars, just fractional claims on a pool that may not exist as promised. Multiple analysts estimate LBMA market makers operate at 300 to 1 leverage between paper claims and actual deliverable metal. For every real ounce in London vaults, there are 300 paper claims. The system depends entirely on the assumption that almost nobody demands physical delivery simultaneously. Here's why December 26th marks the beginning of the end. According to CME clearing data, COMEX registered inventory sites at roughly 210 million ounces. The CFTC's Commitments of Traders report shows commercial banks collectively hold short positions of approximately 212 million ounces. The entire collective short position of major banks roughly equals total COMEX inventory. One large delivery demand doesn't strain the system, it empties it completely. When Shanghai pays $8 to $10 premiums over COMEX, arbitrage traders should buy New York silver cheap and ship it to China for profit. But that arbitrage isn't happening, which means either logistical chains are broken, export restrictions prevent it, or COMEX physically cannot deliver at quoted prices without triggering systemic failure. Major bullion dealers report delivery delays from LBMA vaults stretched from 2 weeks to over 6 weeks. When delivery times triple during supposedly stable supply, the metal isn't where the paper market claims. 8 minutes before market close on December 27th, someone placed substantial options positions on junior silver miners, expiring January 16th, 2026. These were concentrated directional bets engineered to profit from explosive upside in mining equities. Professional traders call this informed flow, positioning ahead of a major catalyst. The bet wasn't for silver going down. It anticipated violent repricing, suggesting whoever placed it knows current suppression is temporary. The December 26th margin hike wasn't the CME's first weapon against silver rallies. In 1980, margins raised 5 times in 9 days broke the Hunt brothers, crashing prices 30%. In 2011, rapid hikes halved silver from $49. But here's the critical difference. This shortage isn't speculative, it's structural. You can break leveraged speculators with margin hikes. You cannot break Chinese industrial demand or conjure new mine production with exchange rules. This time, margin hikes eliminate speculators, but do nothing about physical shortage, meaning when prices move, the violence will be exponential. According to the Silver Institute, global demand for 2024 hit 1.24 billion ounces, while supply delivered only 1.01 billion ounces, an annual deficit of 230 million ounces. That's the 5th consecutive deficit year. Despite 5 years of shortages, prices remained range-bound, held down by overwhelming paper selling from banks never intending to deliver. Physical premiums for American Silver Eagle coins have reached 25 to 35% above spot. When you buy a coin, you're not paying the quoted $75, you're paying $95 to $100. These retail premiums show what the physical market really costs when paper promises don't matter. According to COMEX data, 14 consecutive days of inventory outflows totaled over 33 million ounces removed from registered vaults, the longest continuous drawdown in nearly a decade. Each ounce leaving permanently reduces the buffer for future delivery demands. Shanghai's 56% drawdown in 90 days represents something mathematically impossible under normal conditions. When sophisticated Chinese traders see their government restricting exports while Western exchanges raise margins and Swiss regulators pressure banks, they reach the obvious conclusion. Get physical now while conversion is possible, because that window is closing. Think about the cascading timeline. December 26th, margin shocks begin. January 1st, Chinese licensing takes effect. Mid-January, those mysterious mining stock options expire. Throughout 2026, Swiss pressure on UBS intensifies. These aren't isolated events, they're sequential pressure points, where each stage amplifies the next, compounding exponentially. What you're witnessing isn't a normal market correction. It's a systemic break between paper promises and physical reality, and the people who understand this are already positioning for what comes next. Now, let me show you the mathematical proof that this isn't just market volatility. It's systemic failure baked into the numbers. What I'm about to reveal comes directly from official regulatory data that anyone can verify, but almost nobody bothers to connect. The Commodity Futures Trading Commission publishes weekly reports showing exactly how much silver major banks are short. And when you compare those numbers to actual available inventory, the conclusion is inescapable. The big banks cannot deliver on their obligations without triggering complete systemic collapse. According to the CFTC's Commitments of Traders report, which breaks down futures market positions by category, 22 major commercial banks collectively hold net short positions totaling approximately 212 million ounces of silver. Now, pull up the CME's own warehouse reports showing COMEX registered inventory. That's the silver actually available for immediate delivery against futures contracts, sitting in approved vaults with proper documentation. The current registered inventory sits at roughly 210 million ounces. Read those numbers again. The bank's collective short position exceeds total available COMEX inventory. This isn't a temporary imbalance. It's structural insolvency hidden in plain sight. What does this mean in practical terms? If even one large institutional buyer decides to stand for delivery on their contracts instead of rolling them forward or settling in cash, the entire system empties. We're not talking about a supply squeeze that drives prices higher until new sellers emerge. We're talking about a delivery default where contracts cannot be fulfilled at any price because the physical metal simply does not exist in the quantities promised. This is the equivalent of a bank run, except instead of depositors lining up for cash, it's traders demanding the silver their contracts legally entitle them to receive. Have you ever wondered why banks would maintain such massive short positions in a commodity experiencing multi-year supply deficits? The answer takes us into the documented history of precious metals manipulation that cost these same institutions over $1.3 billion in regulatory fines. Between 2008 and 2016, according to settlements with the Department of Justice and CFTC, 8 major banks engaged in systematic spoofing of silver and gold markets. JP Morgan Chase, the largest player, paid $920 million to settle charges that its traders placed and canceled thousands of orders with no intention of execution, solely to manipulate prices and profit from the artificial movements they created. Let me break down how spoofing actually works, because understanding the mechanism reveals why current market structure enables continued manipulation. A bank trader places a large sell order for silver futures, maybe 10,000 contracts representing 50 million ounces. Other market participants see this huge sell order hit the book and assume someone knows something or needs to liquidate urgently. Algorithmic trading systems detect the large sell order and automatically place their own sell orders to front-run the expected price decline. Within seconds, the price drops. The original bank trader then cancels their large sell order before it executes and instead buys silver at the artificially suppressed price they just created. They never intended to sell. They intended to manipulate price through the illusion of selling pressure. The Department of Justice called JP Morgan's spoofing operation a criminal scheme that ran for nearly a decade. Federal prosecutors documented over 840,000 separate spoofing orders across precious metals markets. These weren't rogue traders making bad decisions. According to court filings, this was systematic institutional behavior involving senior traders, approved by supervisors, executed across multiple trading desks. The bank paid nearly $1 billion because the evidence was overwhelming and undeniable. Yet, here's the question nobody wants to answer. If this behavior was so profitable that banks engaged in it systematically for years, despite knowing it was illegal, what makes anyone think it stopped after the fines? According to analysis by Precious Metals, researchers tracking order flow patterns, spoofing behaviors consistent with the documented 2008-2016 schemes continue appearing in silver markets, just with more sophisticated masking to avoid detection. Modern spoofing uses smaller order sizes, faster cancellation times, and algorithmic coordination across multiple accounts to achieve the same price manipulation with lower regulatory risk. The incentive structure hasn't changed. Banks still profit enormously from suppressing silver prices while holding massive short positions. Only the execution techniques evolved. Now, let's talk about why China's January 1st export restrictions represent the catalyst that finally breaks this manipulation pattern. For years, Western banks could suppress paper prices, knowing that Chinese refiners would continue shipping physical silver to London and New York warehouses, providing the inventory buffer needed to prevent delivery failures. According to Chinese customs data, the country exported over 4,600 tons of refined silver in the first 11 months of 2024. That's the supply valve that allowed COMEX and LBMA to function despite structural deficits. But on January 1st, 2026, that valve closed. China's new licensing system requires exporters to prove annual production exceeding 80 tons, demonstrate consistent export history from 2022 through 2024, and maintain credit lines around $30 million. According to the Ministry of Commerce, only 44 companies received approval for 2026-2027 exports. This is on a temporary policy. It's a 2-year framework designed to prioritize domestic industrial consumption over Western financial market needs. Chinese solar manufacturers, electronics producers, and electric vehicle companies compete for the same silver that Western banks need to cover short positions and meet delivery obligations. And Chinese manufacturers will pay whatever premium is necessary because they need physical silver to maintain production, while Western banks merely need silver to settle bets they never intended to fulfill physically. Let's examine the London Bullion Market Association structure because this is where the leverage crisis becomes truly catastrophic. LBMA operates primarily on an unallocated basis, meaning most silver held in member vaults isn't assigned to specific owners, but exists as fungible claims on a general pool. According to industry estimates based on clearing volumes and reported inventories, LBMA market makers, including UBS, HSBC, JP Morgan, and other major banks, operate at paper-to-physical ratios approaching 300 to 1. For context, fractional reserve banking typically operates at 10 to 1 reserve ratios. What LBMA does with precious metals makes fractional reserve banking look conservative. Think about what 300 to 1 leverage means when physical supply gets cut. If Chinese restrictions reduce global tradable silver by even 10%, and that 10% reduction translates to actual inventory drawdowns in London vaults, suddenly the leverage ratio isn't 300 to 1 anymore. It's 330 to 1, or potentially much higher depending on where the supply reduction hits. Each percentage point of inventory decline, when you're operating at extreme leverage, creates exponential stress on the system's ability to deliver. And remember, this is occurring simultaneously with COMEX inventory drawdowns, Shanghai vault collapses, and Swiss pressure on UBS to restructure positions. According to reports from multiple bullion dealers operating in both London and Asian markets, the physical premium structure tells you everything about LBMA's delivery capacity. When Shanghai spot prices trade $8 to $10 above LBMA benchmark prices, it means Asian buyers don't believe they can obtain silver through London at quoted rates. They're willing to pay substantial premiums to secure supply through Chinese domestic markets, because they've already discovered that placing orders through LBMA results in extended delivery delays, partial fills, or outright rejections with excuses about vault logistics or documentation requirements. The premium isn't reflecting transportation costs or import duties. It's reflecting the physical market, his assessment that London's unallocated system cannot actually deliver at the prices it quotes. Let me show you how the numbers compound when multiple pressure points hit simultaneously. UBS needs to free up $24 billion in capital according to Swiss regulatory proposals. If the bank holds hypothetically a $10 billion notional short position in silver derivatives, not an unreasonable estimate given the bank's market-making role, and silver prices spike from $75 to $150, that position now shows a $10 billion unrealized loss. To close the position, UBS must buy silver to cover shorts, which pushes prices even higher, increasing losses on remaining short positions. This is the classic short squeeze dynamic, except it's happening to a systemically important financial institution that cannot be allowed to fail. What happens when a too-big-to-fail bank faces a short squeeze in a commodity market experiencing a physical supply crisis? According to financial stability research, the central bank faces an impossible choice. Let the bank take catastrophic losses that threaten solvency, or intervene to suppress commodity prices and bail out the bank's bad bets. But here's the twist in 2026. You cannot suppress physical commodity prices through monetary policy when the shortage is real and industrial buyers need the physical material regardless of price. Chinese electronics manufacturers don't care what the Federal Reserve says about silver prices. They need silver paste for circuits, and they'll pay whatever physical suppliers demand. Here's a scenario almost nobody is discussing, but which becomes increasingly plausible given current dynamics. What if COMEX or LBMA declares force majeure and allows cash settlement of contracts instead of physical delivery? This has happened in other commodity markets during supply disruptions. Exchanges change rules mid-crisis to prevent delivery failures that would expose the paper market as fraudulent. Legally, futures contracts include provisions allowing cash settlement under extraordinary circumstances. But imagine you are an institutional investor who bought silver futures specifically to obtain physical metal for industrial use or vault storage. The exchange tells you that instead of receiving the 1 million ounces your contracts entitle you to, you'll receive cash payment at a settlement price that doesn't reflect actual physical availability. Your response would likely involve lawyers, lots of lawyers. According to legal analysis of commodity futures regulations, forced cash settlement of precious metals contracts would trigger immediate litigation, arguing that exchanges violated their fiduciary duty to maintain market integrity and enable legitimate price discovery. The lawsuits would not just target the exchanges, they'd target the banks, whose short positions created the delivery crisis necessitating the rule change. Discovery in those lawsuits would expose internal communications, trading strategies, and risk management failures that banks desperately want to keep confidential. The legal exposure could dwarf the billion-dollar manipulation fines already paid. Now, think about how this affects your investment portfolio, even if you don't directly own silver. According to modern portfolio theory, which underlies most automated investment strategies, commodities serve as inflation hedges that stabilize portfolio performance during periods of currency debasement. But MPT assumes that commodity prices accurately reflect supply and demand fundamentals. If silver markets expose that prices are systematically manipulated and divorced from physical reality, What does that say about other commodity markets? Is copper accurately priced? What about oil or agricultural commodities? The credibility crisis extends far beyond silver. Let's return to those January 16th options positions, placed 8 minutes before market close on December 27th. Whoever positioned those trades needed three things: substantial capital to deploy, sophisticated understanding of option Greeks and expiration dynamics, and specific knowledge that a major catalyst would emerge before mid-January. The positioning wasn't vague directional speculation. It was precise targeting of a 3-week window. What happens mid-January? Options expiration coincides with increased reporting of Chinese export data, year-end financial statements from major banks showing Q4 positions, and typically increased physical demand from Asian buyers preparing for Lunar New Year. Someone knew that confluence of factors would expose the physical shortage that December margin hikes temporarily masked. According to options market analysis, the specific strike prices and expiration timing of those mining stock positions suggest the buyer expected silver to trade substantially higher, perhaps $100 to $120, by mid-January, driving mining stocks to multiples of current prices based on operational leverage. Those options didn't pay off if silver merely stabilized or edged slightly higher. They required explosive upside that would shock the market and create fear of missing out buying that feeds on itself. The question is whether the buyer's timing proves accurate, or whether the banks managed to delay the inevitable crisis by a few more months through coordinated intervention. Here's what keeps me up at night about this situation. We're watching a slow-motion collision between two incompatible realities. Physical reality says silver supply cannot meet demand, inventories are depleting, and industrial consumers need the metal regardless of price. Financial reality says banks hold massive short positions that cannot be covered without catastrophic losses. Exchanges set prices through paper trading, disconnected from physical availability, and the system depends on confidence that paper and physical remain equivalent. When these two realities collide, when the physical shortage forces acknowledgement that paper claims exceed deliverable metal by orders of magnitude, the repricing will not be gradual. It will be violent, sudden, and wealth-destroying for anyone positioned on the wrong side. Now, let me show you the exact calculations that prove why silver's paper market collapse is not just likely, it's mathematically inevitable. And more importantly, I'll give you the specific price targets and timeline for when this repricing happens. Because what we're witnessing isn't speculation about what might occur. It's arithmetic about what must occur when supply and demand realities finally overwhelm paper market manipulation. China's January 1st, 2026 export licensing system does not just reduce silver supply, it removes the primary shock absorber that allowed Western paper markets to function. According to Chinese customs data and Ministry of Commerce reports, China controls approximately 60 to 70% of the world's tradable refined silver through its dominant refining infrastructure. Even though China produces roughly 15% of mined silver globally, the country processes and refines silver from concentrate imported from Latin America, Australia, and other regions. When you control the refining bottleneck, you control the actual deliverable supply regardless of where ore originates. Here's the arithmetic that seals the outcome. According to the Silver Institute's World Silver Survey, global industrial and investment demand for 2024 totaled approximately 1.24 billion ounces. Total supply from mine production plus recycling delivered roughly 1.01 billion ounces. That's an annual structural deficit of 230 million ounces, and that's the 5th consecutive year of deficits. When you cut China's export capacity by even 30 to 40% through licensing restrictions, you're removing an additional 150 to 200 million ounces from Western markets annually. The math is brutal. Western markets now face annual shortfalls approaching 400 million ounces with no new supply sources capable of filling the gap. Think about what 400 million ounces means relative to available inventory. COMEX registered stocks sit at 210 million ounces. LBMA doesn't publish complete inventory data, but industry estimates based on clearing volumes suggest London vaults hold perhaps 300 to 400 million ounces of allocated and unallocated silver combined. If Western markets face 400 million ounce annual deficits and total exchange-held inventory is roughly 600 million ounces, you're looking at complete inventory depletion in 18 months, assuming no intervention. But here's the reality. Depletion won't take 18 months because as inventories decline, panic buying accelerates. The final drawdown happens exponentially faster than the initial depletion. Now, let's talk about price targets, because this is where official bank forecasts diverge dramatically from physical market reality. According to physical market data from Shanghai dealers, actual transaction prices for delivered silver already exceed $80 per ounce in Asian markets when you add the $8 to $10 premiums to current COMEX quotes around $73 to $75. The physical market in Asia, where industrial buyers actually consume the metal, is already pricing silver 30 to 40% higher than Western paper markets acknowledge. This divergence tells you everything. Paper price discovery has already failed. The prices quoted on COMEX and LBMA no longer reflect what it costs to obtain actual deliverable silver in meaningful quantities. Let me give you the specific price pathway I see unfolding based on supply-demand arithmetic and historical precedent. $70 becomes the floor, not because of technical chart analysis or sentiment indicators, but because Chinese industrial buyers have demonstrated willingness to pay $75 to $85 for physical delivery. Below $70, Asian demand would absorb every ounce of available supply instantly, creating immediate arbitrage that pulls prices back above the floor. This floor exists regardless of what happens with COMEX margin requirements or Federal Reserve policy, because it's set by real industrial consumption that cannot be eliminated through financial engineering. The next phase, and this is where timing becomes critical, involves forced covering of bank short positions. According to CFTC data, the commercial bank's short position of 212 million ounces represents roughly 20% of annual global supply. If banks need to cover even half those shorts over 6 months, they're trying to buy 100 million ounces in a market already running 230 million ounce annual deficits before China's export cuts. That additional demand drives prices to $100 to $120 as banks compete desperately for available supply. This isn't speculation, it's what happens when demand substantially exceeds supply in any commodity market. But here's where it gets truly explosive. According to analysis of the 1980 Silver Thursday collapse and 2011 margin hike crashes, CME's historical playbook relied on breaking leveraged speculators who couldn't meet increased margin requirements. The Hunt brothers in 1980 were speculators using leverage to accumulate silver for investment purposes. When CME raised margins 5 times in 9 days and the Federal Reserve restricted lending for commodity speculation, the Hunts couldn't meet margin calls and were forced to liquidate, crashing prices from $50 to below $10 within months. In 2011, leveraged hedge funds drove silver from $30 to $49, and CME margin hikes forced those leveraged longs to sell, halving prices. The critical difference in 2026 is that the shortage is industrial, not speculative. Chinese solar manufacturers need silver paste for photovoltaic cells, whether COMEX margins are low or high. American electronics producers need silver for circuit boards and conductive materials, regardless of futures market leverage ratios. Electric vehicle manufacturers require silver for electrical components, and battery technology independent of speculative sentiment. You cannot break industrial demand with margin hikes because industrial consumers aren't leveraged speculators. They're companies that must have physical silver to maintain production, or they shut down manufacturing. This fundamental difference means CME's December margin hikes eliminated the speculative froth without addressing the underlying physical shortage. When prices inevitably spike again, and they will because 400 million ounce deficits cannot be papered over indefinitely, there won't be leveraged speculators to shake out. There will only be industrial consumers bidding desperately for supply and banks scrambling to cover shorts before losses become terminal. That's when prices reach $100 to $150 in the second quarter of 2026. Now, here's the scenario that creates retail premiums approaching $105 per ounce. During acute delivery panics, retail buyers compete for available inventory from dealers who themselves cannot obtain wholesale supply reliably. According to precious metals dealer reports, current retail premiums for American Silver Eagles already exceed 30% in some markets. If wholesale spot prices reach $120 to $130 during peak short covering panic, retail premiums could expand to 40 to 50% as dealers price and delivery uncertainty and inventory scarcity. That mathematical path leads to retail silver coins trading near $170 to $195, not because of retailer greed, but because the entire distribution chain from mine to consumer is experiencing unprecedented supply stress. Think about what this means for our broader economy. According to the U.S. Geological Survey and Department of Energy studies, silver is critical for achieving renewable energy targets, next-generation electronics, and advanced manufacturing. If silver prices triple or quadruple from recent levels, the cost structure of solar installations, electric vehicles, and electronics manufacturing changes fundamentally. Companies either absorb massive margin compression, pass costs through to consumers driving inflation, or delay capacity expansion, waiting for prices to stabilize. None of those outcomes help our economic competitiveness or technological leadership. But here's the empowering reality. Understanding what's happening positions you to adapt rather than become a victim. If you're an investor, the message is clear. Paper silver claims through ETFs or unallocated accounts carry counterparty risk that physical holdings don't. If you're a business owner in affected industries, securing supply chains and hedging input costs now, before prices spike further, protects your margins. If you're a consumer considering solar installation or major electronics purchases, understanding that prices will likely rise significantly in coming quarters might accelerate your decision timeline. According to portfolio strategists, what's happening in silver markets represents a broader pattern: the collapse of financialized commodity markets divorced from physical reality. For decades, Western financial engineering allowed paper trading to dominate price discovery, enabling leverage and manipulation that suppressed prices below physical market clearing levels. But when a major supplier like China restricts exports for strategic reasons, the house of cards collapses. Physical reality reasserts itself, and prices must rise, often violently, to levels that balance actual supply and demand, rather than paper trading dynamics. The timeline we're watching accelerates with each passing week. January's Chinese export data will show the impact of new licensing restrictions. February brings earnings season, where mining companies report production costs and major industrial consumers discuss input cost pressures. March and April hit peak Asian buying season for both industrial and investment demand. By Q2 2026, the combination of sustained deficits, bank covering, and industrial competition for shrinking supply creates conditions for the explosive repricing that moves silver from current levels toward $150. Here's my final calculation for you. At $150 silver, mining companies currently producing at $35 all-in costs generate $115 profit per ounce, more than tripling current margins. That's why those January 16th options on mining stocks represented such asymmetric risk-reward. Even if silver only reaches $100, junior miners with high-grade deposits see profits increase 5 to 10-fold. This is not speculation, it's operational leverage arithmetic that has made mining equities the preferred way to capture commodity repricing throughout history. But remember, this isn't about getting rich on silver speculation. This is about understanding a systemic break in how global commodity markets function and positioning yourself accordingly. Whether you own physical silver mining stocks or neither, what happens in silver markets over the next 12 months tells you something crucial about our financial system: its fragility and the limits of paper market manipulation when physical reality intervenes. The silver betrayal isn't about some conspiracy to suppress prices. It's about the inevitable consequences when leverage, manipulation, and financialization meet physical scarcity and industrial demand. The math doesn't lie, the inventories don't lie, and increasingly, the price premiums in physical markets reveal that the paper prices do lie. What you do with that information determines whether you adapt successfully or get caught unprepared when the repricing accelerates. The choice is yours, but the timeline is no longer flexible. The collision between paper promises and physical reality is happening now, and the smart money is already positioned for what comes next.